my financial fit fam. Welcome back, welcome back, welcome back. I tried. In the previous weeks, we discussed dividend investing and how including some form of dividend investing into your portfolio is important. It gives it more stability, it helps you accumulate your positions, and it can give you a little bit of an income. The truth is, it's also a little slow.
You'll have to excuse my friend. He's a little slow. The town is back that way.
So in today's video, we're going to talk about a new strategy that could lead to higher returns, but it usually comes with more risk, and that's a growth investing strategy. Now we'll talk about exactly what a growth investing strategy is. We'll talk about the pros, the cons, but not the ex-cons. And we'll also talk about how to develop an approach when it comes to building a growth investing portfolio. So let's get going. So if you really want to grow your portfolio and your intellectual capital, smash the subscribe button and smash the like button. The concept of growth investing is rather simplistic. You're investing in a stock that's obviously attached to a business that is in the growth phase of its business cycle. And this includes things like increased earnings, increased revenues, but also some of the non-metric metrics? Like customer loyalty, brand value, and what Warren Buffett always talks about, the competitive advantage. Now just keep in mind, growth companies traditionally come from growth sectors or growing industries. Let's look at Amazon, for example. Now, Amazon was growing prior to the pandemic, but COVID-19 definitely exacerbated the fact that it's still within its growth phase, right? Everyone now is shopping online, and e-commerce is becoming a larger and larger business, and therefore Amazon keeps growing. However, every once in a while, you'll find yourself a unicorn in a dying sector. So if you look at Tesla, for example, and the car sector as a whole, they're kind of going in opposite directions. Tesla has unbelievable customer loyalty, unbelievable brand value. It has the competitive advantage, really implementing electric vehicles before anybody else, while the rest of the car companies are dying. Put them to sleep. So there are two ways that you can identify whether a company is still in the growth phase. The first of which is by going directly through the financials. And you can go on MarketWatch or Yahoo Finance and look at that company's income statements. Now, if the revenues or the earnings are growing every quarter or annually, that company is most likely still in its growth phase. The second thing you want to look at is the PE ratio, which is the price per earnings. Now, this can be found right there on the summary. This number is indicative of what that stock is trading at compared to that company's current earnings. If the multiple is very high, that most likely suggests that analysts have a high ceiling and high growth expectation for that stock. If the PE ratio is low, that company might be on the downswing, or it might be very undervalued and a good opportunity. So let's look at some examples. The PE ratios and the income statements of a couple different companies. So first we're going to take a look at Apple. You're going to open up marketwatch.com, search the ticker, and then scroll down to the middle section where you'll see a bunch of summary financial information. Here we'll take a look at the PE ratio on the left-hand side. You'll see it's just under 35. And the other important factor here is going to be earnings per share, which is just to its right. The PE ratio is the current stock price compared to its earnings per share. It's basically the premium multiple that someone would pay for the stock right now. To own a share of Apple, you're currently paying 35 times its current earnings. Now we're going to take a deeper dive into the income statement. So you click on financials, and this will automatically bring you up to the annual income statement. Along the top, you're going to see the revenues. So what I personally look for is growth. Year over year, I want to see they're consistently bringing in more and more money. I'll also slide down to the earnings and make sure that the EPS is growing year over year as well. Now we're looking at this from an annual perspective, but we could also change it to quarterly by flipping the button or the drop down in the top right hand corner. I'll read those same metrics again, and I'm also going to click on the view ratios button in the top left hand corner. This will show me the percentage change quarter over quarter and makes reading the financial statements significantly easier. Now it's on to the next one, on to the next one, on to the next one. Freeze. We're checking out some Etsy, please. So pull up the Etsy ticker symbol, scroll down. You can take a look at the PE ratio, super high here, and also the earnings per share. Then we'll click over to the financials to take a deeper dive look. And we're going through that same process, looking at the revenue, looking at the EPS, and looking for that annual and quarterly growth. Make sure to click view ratios in the top left. Look at its annual, look at the quarterly statement. Make sure that you scroll all the way to the bottom, look at the EPS. Growth, 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 growth. That's what we're looking for, people. Let's go. How about something real crazy? Tesla, PE ratio of almost 1100. But just because the PE ratio is high doesn't mean that we don't buy. Hey. So just because Tesla's trading at a bajillion times its PE ratio doesn't necessarily mean it's a bad buy. But it doesn't mean it's a good buy. Or it could be a best buy. Or maybe you can say bye-bye. So with growth companies, you're really paying a premium for the perceived value of future earnings. And that makes it a lot more risky, right? One wrong turn and it could be just because of the inherent volatility in growth stocks, time horizon becomes such a huge concern. If you're going to need that capital in the next few years, you might want to avoid growth stocks altogether. And the last thing that you want to do is sell a stock at a depreciated value because your time horizon wasn't long enough and you weren't able to recoup some of the loss that you might experience during a temporary downtrend. Well, how do you even get started with growth investing? Well, looking for companies that show consistent growth in earnings year over year. Now, you can spend tens of thousands of hours looking at financial statements, income statements, and figure it out for yourself. Or you can do what any rational human being would do and use a stock screener. As a matter of fact, there's several that are free, and it's a database that allows you to put certain financial information that you're looking for into the system, and it spits out companies that fit the profile. Just make your life a little easier. I personally use Zach's stock screener. It's free, it's user-friendly, and it gives me the information I need. I'm going to drop a link in the description below as well, so if you want to take a look for yourself. No affiliation with Zach's. Zach is not a friend of mine. I just like it. You also need to identify what percentage of your portfolio you want to put towards a growth investing strategy. Remember, there is more volatility, it's more aggressive, there's more risk, but there's also greater potential. You don't have to just buy stocks in order to be a growth investor. You can buy growth index funds or ETFs, and this helps give you diversification while keeping the expense cost low. While buying individual growth stocks carries the greatest risk, it also brings with it the greatest opportunity for a great potential return. Here are the 4 things that I look for when screening a stock. The first of which is an above average EPS. The second, an above average gross margin. Number 3, a history of positive revenue growth. And number 4, a high return on invested capital. While those are all measurable metrics, keep in mind the 2 intangibles, which include brand value and also just overall quality of leadership. With any portfolio, you want to maximize returns. And you're going to have that opportunity when you see a stock that becomes the rising star and is now making up 60, 70, 80% of your portfolio. well, it might be time to rebalance. Or maybe a company totally exceeds your expectations and is trading at 20, 30, 40 times what you thought it ever would be worth. An opportunity to sell some of those shares and find another growth company to invest in. Or companies do make missteps. Management makes bad decisions, legislation changes, and sometimes another company just comes in and disrupts the sector. Another opportunity to sell shares, look for other growth investing opportunities, and keep building your portfolio. If you want to learn more about growth investing or growth investing strategies, read Peter Lynch's One Up on Wall Street. I actually haven't read this book yet myself, but I did add it in the description below on my book list. It is the next one I'm going to order, and I will have it done by the end of November, I promise. If you want to get started with investing but haven't just yet, take a look in the description for my top 3 brokerage houses. Overall, growth investing helps build capital quicker. It's not the right investment strategy for everyone, but it is predominantly what I use in my own portfolio. I'm hoping you've seen some value out of today's video and that you've at least gotten one nugget that you can implement for yourself. As always, save, invest, grow. Ciao, ciao.